Let me tell you something I've learned over a very long life. Money itself isn't complicated. People make it complicated. They chase shortcuts, they panic, they speculate, and they end up broke. But building wealth, real, lasting wealth, is simple. Now imagine this. You're sitting there with $10,000. Maybe you saved it from your first job. Maybe you sold something. Or maybe you've just been disciplined. You're excited, maybe a little nervous, and you're wondering, how do I invest this so it grows into something meaningful? I'll walk you through exactly how I'd approach it if I was starting over with only $10,000. Not as Warren Buffett, the billionaire, but as Warren Buffett from Omaha, the young man who was just trying to turn nickels into dollars. The first and most important thing I can teach you is this. It doesn't matter where you put the money if you don't first have the right habits. See, money is like a seed. If you eat the seed, you'll never grow a tree. If you plant it in rocky soil, it won't take root. But if you plant it carefully, water it, and protect it, one day it becomes a tree that gives fruit season after season. So before you start chasing returns, you need to promise yourself that this $10,000 is not spending money. It's wealth-building money. It's the seed. You don't touch it unless it's to water it. When I was delivering newspapers at 11 years old, I didn't save what was left after spending. I saved first, spent second. That's a lesson you need before you ever make an investment. Now let's get practical. Suppose you've got credit card debt charging you 20%. Should you invest in stocks? Absolutely not. Think of it this way. If you pay off a 20% debt, that's the same as getting a guaranteed 20% return on your money. I've spent my whole career looking for investments that could give me that kind of return, and they're rare. So the smartest move with your first $10,000, if you're carrying high-interest debt, is to pay it off. Don't skip this. Debt is like a hole in the bottom of your bucket. You can pour in as much water as you want, but it'll never fill. Once you're debt-free, the next thing you need isn't an investment. It's protection. Life happens. Jobs get lost, cars break down, doctors send bills. If you don't have a cushion, you'll be forced to sell your investments at the worst possible time, just when prices are down. So set aside a portion of that $10,000, maybe $2,000 or $3,000, in a safe, liquid place, a savings account, a money market fund, somewhere you can reach it instantly. That's your emergency fund. Think of it like the foundation under a house. It's not glamorous, but without it, the whole structure can collapse. Now here's where it gets exciting. If you followed me at all, you already know my advice. The single best investment for most people is a low-cost S&P 500 index fund. Why? Because it gives you ownership of America's best businesses, companies that are run by smart, hard-working people who wake up every morning thinking about how to serve their customers better. And here's the beauty of it. You don't have to guess which companies will succeed. The index takes care of that. The failures get kicked out. The winners rise to the top. All you have to do is hold on. I've said before that if you just put your money in an S&P 500 fund and never touched it, you'd probably do better than 90% of people trying to pick stocks or time the market. So if you're starting with $10,000, put the majority of it, after debt and your safety net, into that index fund. Then don't touch it. Let me show you why. Take that $10,000. If it earns 10% a year, a reasonable long-term average for the stock market, it becomes about $26,000 in 10 years. In 20 years, it's around $67,000. In 30 years, it's $174,000. And remember, you didn't add another dime. That's the power of compounding. Your money earns money, and then that money earns money. Like a snowball, rolling down a hill, it gets bigger and faster as it goes. I started my own snowball early, and it changed my life. But the truth is, it's never too late to start. Even at $10,000, compounding can turn it into something that surprises you if you're patient. Now, some of you are thinking, Warren, I don't just want to buy the market, I want to pick stocks like you did. Well, let me tell you about my first stock. I was 11 years old. I bought 3 shares of City Service Preferred. I thought I was smart. The stock dropped right after I bought it. I panicked. When it rose a little, I sold for a tiny profit. Then it shot way up after I sold. That taught me two lessons. Don't panic and don't sell too soon. If you want to pick stocks with a small piece of your $10,000, that's fine, but follow some rules. Only buy what you understand. If you can't explain how a business makes money, don't buy it. Look for companies that real advantages, that keep rivals out. Demand a margin of safety. Don't pay more than the business is worth. Think like an owner. Would you be happy to own it for 10 years even if the market closed? If you can't follow those rules, don't bother. Just stick with the index fund. Now let me tell you something people forget. Sometimes the best investment isn't in stocks at all. It's in yourself. I'll give you an example. When I was young, I was terrified of public speaking. My hands shook, my voice cracked. I knew it was holding me back. So I took a Dale Carnegie course. It wasn't cheap for me at the time, but it transformed my life. That one investment paid dividends for decades. So if spending some of that $10,000 on a skill, a certification, or a course makes you more valuable in your career, do it. The return on investing in yourself is often higher than anything the stock market can give you. Avoiding common traps. Now let's talk about the mistakes people make with their first $10,000. 1. Trading too much. Every trade costs money. The more you trade, the more you lose. 2. Chasing hot tips. If your barber or your neighbor says a stock is hot, it's already too late. 3. Paying high fees. A 1% fee sounds small, but over decades it can eat away at half your returns. 4. Panic selling. The market will drop. It always does. If you sell every time, you'll miss the recovery. 5. Using leverage. Never borrow money to invest. It can wipe you out. Your first $10,000 is too valuable to gamble with. Protect it, nurture it, let it grow. Thinking in decades, not days. This is one of the most important lessons I can leave you with. I don't buy a stock unless I'd be happy to own it for 10 years. I don't care what it'll do tomorrow. I care what the business will be worth in the long run. The stock market is a voting machine in the short term, but a weighing machine in the long term. Prices bounce around like crazy, but over time, value always wins. So train yourself to think in decades, not days. That's how you turn $10,000 into real wealth. So far, we've laid the foundation. We've talked about habits, safety nets, index funds, compounding, and even investing in yourself. But we're not done. In the next part, I'm going to go deeper. We'll talk about exactly how to structure your portfolio, how to keep emotions in check, and how to build a lifetime plan around that first $10,000. Because remember, it's not just about the money. It's about building freedom. When we left off, I told you that investing your first $10,000 isn't only about money. It's about freedom. It's about building a foundation that allows you to live life on your own terms. Now let's go deeper. I'll show you not just where to put the money, but how to think about it, how to protect it, and how to keep building on it for decades to come. Building your portfolio the Buffett way. Once you've paid off debt, set aside an emergency fund, and bought your first index fund, you've taken big steps forward. But what comes next? Well, I like to think of a portfolio the way I think of a farm. If you bought a farm, you wouldn't check the price every day. You'd care about how the crops were growing, whether the soil was good, and whether you had the right mix of crops and animals to support you year after year. Your portfolio works the same way. It doesn't have to be complicated. In fact, simpler is better. For someone with $10,000, here's how I think about it. 70 to 80% in a broad S&P 500 index fund. This is your farm's steady crops, the corn, the wheat, the things that grow year after year. 10 to 20% in international index funds. These are like planting some fruit trees from different climates. Not everything grows in Omaha. Some great businesses are in Europe or Asia. 5 to 10% in cash or short-term bonds. This is your dry powder. It gives you flexibility if opportunities come along or if life throws you a curveball. And if you're itching to pick individual stocks, set aside maybe 5%. That's your classroom money. You'll learn a lot. You may make mistakes, but by keeping it small, those mistakes won't ruin your future. Now, how to judge a business. Suppose you want to use part of that $10,000 to buy individual stocks. How do you know which ones to pick? Here's the test I use. Pretend the stock market will close for the next 10 years. Would you still want to own this business? If the answer is no, don't buy it. Ask yourself, does the company sell something people will still need in 10 years? Does it have a moat, a competitive advantage that keeps rivals away? Is it run by managers you trust? And most importantly, is it selling at a fair price, or are you overpaying? Take Coca-Cola. People have been drinking it for 100 years. They'll keep drinking it. The brand is powerful. The moat is wide. That's the kind of business I like to own. If you can find a business like